Hello, everyone. Thanks for coming out. Before we dive into our presentation, let's warm up with a little brain teaser about Bill. Let's get started. So, after working hard his adult life, Bill, 63, has finally retired, and he's going to more concerts now than ever before. Bill has $58,688 in taxable income, which includes $37,500 of Social Security benefits this year. As you can see, Bill's $58,688 of taxable income puts him in the 22% tax bracket because it's more than $50,401 and less than $105,700. Toward the end of the year, Bill decides to take an extra $1,000 out of his IRA for a trip to see Willie Nelson play in Austin. How much is he taxed on that extra $1,000? The logical answer is that every dollar of IRA money he pulls out, he pays 22 cents in federal income taxes. Therefore, if he took out $1,000, he should owe $220 in federal income tax. 22% tax. Simple enough, right? Well, he owes $407 in tax, a 40.7% tax on that income. Thanks to the madness of our tax code and the unique formula that determines how Social Security benefits are taxed, the real answer is that Bill owes $407 on that extra $1,000 of income. Welcome to our presentation, How Tax Planning Changes Through 4 Stages of Retirement. My name is Joseph Budd, and I'm a certified financial planner and managing director with Budd Wealth Management. We have designed and refined our client life process over the last 20 years to work with families that aspire to a work optional lifestyle. We hope to put all the pieces of the financial puzzle together for our clients. Follow us on Facebook, LinkedIn, and Instagram for personal finance content and invitations to future educational events. Visit us at buddwealth.com, where you can learn more about our process, watch our videos, and request our introductory kit. This session is being recorded, and you'll receive a link to the recording in a follow-up email. I thank you for coming out to learn more about taxes and retirement. And I want to assure you that one thing about this presentation, I believe you'll be better informed about the challenges of retirement tax planning after listening to this presentation. Now you're wondering, why is a financial professional giving a presentation about retirement tax planning? Well, from time to time, I present workshops and classes on various financial topics such as retirement planning, Social Security, IRA planning, healthcare planning, cybersecurity, late-stage college planning, among others. My goal is to inform and educate my audience so you can understand how critical financial topics affect you and your family. I do this presentation because I've seen many people make mistakes and pay more in taxes in retirement than is necessary. And when that happens, it makes my job harder because people have less income in retirement, and we have to find ways to make their portfolios last. Taxes can seem complex and jargon-filled, even though the underlying concepts are fairly straightforward. So let me take a second to explain how this workshop will unfold. This presentation is organized in 4 keys. Each key builds on the previous one to form a solution to our presentation problem, as you'll see. To help you remember what we're covering tonight, there will be resources that will be email delivered after this presentation. There's also a summary of the challenges during the 4 stages of retirement document and a 2026 key data document that will assist you in your planning needs. Because of the complexity of today's presentation, I'm not going to take questions during the presentation, but there'll be a resource for you to follow up and get your own specific questions answered. All right, let's get started. Everyone's tax situation is different. You should always consult a qualified professional tax advisor to discuss your specific tax situation, especially about these topics. Traditional IRAs, tax deferred. You must pay taxes on distributions or conversions at ordinary federal and state rates, if applicable. Roth IRA, non-deductible, money grows tax-free, and earnings will be withdrawn tax-free in accordance with IRS rules. State taxes. This presentation references federal taxes. You may still face state taxes depending on where you're located. Check with your tax professional. I'm a financial professional and I do not provide tax advice. What I do is help people understand how the tax code and other rules can impact their financial planning and investments, and then we develop a plan to take into account many of the odd things people encounter, especially around taxes and retirement. Our goal here is to help you understand that the retirement distribution game, spending assets in retirement, is much different than the accumulation game when you're saving for retirement. Chances are you've been in the accumulation phase of your life for several decades and you've been working hard trying to save, and hopefully your accounts have grown. But now as you enter and prepare for retirement, you're in an entirely different phase, the distribution phase. And the distribution phase has new, strange rules that can catch people off guard. And along with those rules, there are often many changes in your own personal life that can have a big impact on taxes too. For instance, your children are grown, and that means no more child tax credits. Your house may be fully paid off, and that means no more mortgage interest deduction. If you still have a mortgage in retirement, you can still get the mortgage interest deduction. Under the One Big Beautiful Bill Act, you should be aware of the phase outs for certain credits and deductions and changing tax rules. If you've already retired, you may no longer be receiving tax-free employer-paid medical insurance. If you've stopped working, you may no longer have the ability to stash income in a 401k or similar plan to manage your annual tax bill. At some point, you start taking Social Security, and sooner or later, when you reach 73, you'll have to start taking required distributions from your retirement accounts. The list of changes goes on. Many aspects of retirement will affect your tax bill in ways totally different from your working years. Understanding what these are and how they impact you is absolutely crucial. Now, at this point, you may be thinking, okay, so what's the first thing I need to understand about retirement and taxes? Well, here it is, our first key. You have to know what your after-tax retirement savings picture looks like before you actually retire. Because a $500,000 401k or IRA balance isn't really $500,000. The government has a claim on part of that money because the taxes were deferred. They'll get their share when you're forced to start taking your required minimum distributions. The Secure Act 2.0 has pushed back RMDs to age 73 if you were born between 1951 and 1959, and if you were born after that, you won't have to start taking RMDs until you turn 75. Obviously, the higher your tax rate in retirement, the less your account is actually worth. Here's an example. This chart shows the cumulative after-tax value of a $500,000 IRA earning 6% a year at various tax rates. And as you can see, the lower your tax rate, the more you keep. Simple in theory, difficult in practice. And by the way, of course, this presentation applies to both pre-retirees and retirees. So don't worry if you've already started your retirement. Tax planning is important throughout your retirement. So now you may be thinking, okay, my accounts may not be worth as much as I thought, but I'll have a steady flow of benefits from Social Security to supplement my income, and we'll have Medicare to pay for health costs. But one thing you need to understand when creating your retirement tax strategy is Social Security and Medicare have their own tax traps that you'll need to plan for as well, our second key. Let's go back to Bill from our tax brain tease. We want to understand why he paid such a high tax rate on the extra money he took out from an IRA to go to a concert road trip. Remember, Bill has $45,000 of IRA income, part of his adjusted gross income of $65,538, and he has $37,500 of Social Security benefits that puts him squarely in the 22% bracket, and he takes the standard deduction. Yet, when he took out the extra $1,000 IRA, he got hit with nearly a 41% marginal tax rate on the $1,000. Let's break down how this actually happens. First, let's remember the only difference between our two scenarios here is that Bill took out an additional $1,000 from an IRA. You see in the after concert trip column, he has $46,000 in IRA income. So we see here that by adding the additional $1,000 of income, it increased both his AGI and his taxable income by $1,850. That means for every dollar of income he actually received, he's going to be taxed $1.85. How can that be? Here's the deal. Depending upon how much other income you have, the amount of your Social Security benefits that are taxable varies. For instance, if your other income is low enough, all of your Social Security benefits will be income tax free at the federal level. On the other hand, if your income is high enough, up to 85% of your Social Security benefits can be taxable at whatever your personal rate is. Bill finds himself in the latter scenario. At his current income after the concert trip, for every dollar he takes out of his IRA, he not only adds $1 of IRA money to his taxable income, but he must also add an additional 85 cents of taxable Social Security benefits. And if you add that up, that's $1.85 taxable at his 22% rate for every $1 of additional IRA income he actually receives. And if you do the math, that comes out to a 40.7% real tax on the $1,000 of income. That's the so-called Social Security tax torpedo. It can impact single filers and married filer couples, even with fairly modest income during any stage at retirement. It's one reason planning taxes in retirement is important. Now let's take a look at how Medicare and something it calls IRMA can impact some couples in the go-go years and beyond. First, what is IRMA? It stands for Income Related Monthly Adjustment Amount. The emphasis is on income because it's a monthly tiered surcharge. Again, a kind of tax that is tacked on to people's Medicare Parts B and D premiums. But it only happens if you have income over $109,000 for single filers and $218,000 for married couples filing a joint return. Let's take a look at what this means in action. Meet George and Martha. They are a high-earning married couple and both are Medicare Part B and D participants. IRMA surcharges affect the income from 2 years prior, and this couple was on track for $342,000 of modified adjusted gross income, or MAGI, in 24. But on December 1st, 2024, George decided to sell a stock he bought for $10,000 in July of 2007. He sold the stock for $11,000. The resulting $1,000 of gain was taxed at a 15% long-term caps gain rate, plus an additional 3.8% net investment income surtax for a total federal tax bill of 18.8%. That 3.8% net investment income surtax is another tax that comes into play when your MAGI exceeds $200,000 for singles and $250,000 for married couples. So George and Martha owe $188 on the tax of the gain from the sale of the stock, right? 18.8%. Or do they? Remember, my definition of a tax is any cost that increases as your income increases. So then George and Martha will owe more tax than the $188 because the gain from the sale of the stock pushed them off the Medicare IRMA cliff into paying higher Medicare premiums. Let's take a look at how this works. Look at this Part B IRMA chart. The extra $1,000 gain pushed their AGI into the next premium tier that starts with $342,001. So now instead of owing $405.80 each for their monthly Medicare premium Part B premiums, George and Martha will owe $527.50 per month, an extra $121.70 per month times two, $243.40 for an annual total additional income related monthly adjusted Medicare Part B premiums of $2,920.80. But it's not over because Medicare Part D IRMA charges are also impacted. George and Martha will each pay another $22.90 a month for their drug plans, an extra $549.60 for the couple over the course of a year. Adding all the IRMA surcharges together for the year, George and Martha will each owe an extra $144.60 a month, or more than $3,470.40 of combined additional charges for the year. Now combine the amount of the $188 of actual federal income tax they would owe on their stock sale, and the total tax owed on the $1,000 of gain comes to $3,658.40. That's a tax rate of 365%. I'll repeat that. That's a tax rate of 365%. Let's do a quick review. They sold the stock for a $1,000 gain. Stock sale tax was $188, 15% for long-term cap gains and 3.8% for the net investment income tax for high earners, an 18.8% rate. The extra income from the stock triggers IRMA tiers. Total IRMA surcharges for the year, $3,470. You see, being pushed into a higher Medicare B and D premium range is worse than being pushed into a higher tax bracket. That's because if you go over a regular tax bracket by even a single dollar, only those last dollars are taxed at the highest rate. But if you go over the Medicare Part B and D income levels by even a single dollar, you move into the next premium tier. It doesn't matter if you exceed the limit by $1 or $10,000. That's why they call it the IRMA cliff. Keep in mind your IRMA payments aren't determined by how much money you made the previous year, but rather your MAGI from 2 years ago. It's another tax thing that catches people by surprise and needs planning. Making sure that you enroll in Medicare at the right time is a critical decision. If you bungle it, you get hit with a lifelong penalty. To help you understand, meet Jim and Ann, both 68. Jim retired at 65 and Ann retired at 66. Prior to her retirement, the couple had health insurance through Ann's employer, and they continued that after Ann retired because her employer offers retiree health benefits. Unfortunately, they didn't know that they had to enroll in Medicare Part B as soon as Ann retired. Even though Ann's employer offers retiree health insurance benefits, those benefits are generally paid secondary to Medicare after retirement. But Jim and Ann didn't realize the mistake until it was too late. And thanks to the way Medicare enrollment periods work, they weren't able to begin coverage until the next year. In a worst case scenario, this may have resulted in a gap in coverage for Jim and Ann if they had a major medical need. But even in the best case scenario, because Jim and Ann missed their deadline for sign up for Medicare Part B, they will each owe a 10% Medicare Part B base premium penalty for life. You can see how much that translates into real dollars. They owe $486.96 extra in 2026. And now historically, we can estimate that premiums will be higher so that 10% penalty will grow and grow, and over the course of their lifetime, that could translate into $10,000 mistake for this couple. For simplicity's sake, we're assuming that Ann's retiree health insurance covers prescription drugs, so they don't have to sign up for Part D. Just know that there's a penalty for that as well. We've seen how Social Security and Medicare have their own tax traps and unique rules and penalties. So if you're like some who've seen this presentation, you may be saying to yourself, wow, are there other tax traps we will face in retirement? Well, the rest of what we'll cover isn't like what we've seen with Social Security tax torpedo or the Medicare Irma cliff. The public generally isn't aware of those tax squeezes. What we're going to see now is how the tax code in plain view snags retirees, especially when there's no planning. And that brings us to our third key. You must plan now how and when you will use taxable, tax deferred, and tax-free assets to manage your income and tax brackets efficiently. You can't be haphazard about tapping your tax deferred savings. Timing is everything, and if you don't plan carefully through all stages of retirement, you'll encounter unintended tax consequences. Let's take a look by first addressing a question I often hear when doing retirement planning: which accounts to spend first? One way to help manage your income both before and during retirement is to utilize Roth IRA conversions. A Roth IRA conversion is a simple process that allows you to move money from an IRA and other pre-retirement income account like a 401k or Roth IRA. In general, the amount that you convert to your income for that year will be added to your income for that year and will be taxed at your rate. For example, if Jill converts $100,000 from her IRA to a Roth IRA, she will have to add $100,000 to her income. The conversion income will be taxed at Jill's rate. For that reason, it's recommended that prior to making any conversion, you consult with your tax professional. A conversion doesn't need to be all or nothing, though, and one helpful conversion approach is called filling up the bracket. Often you may find yourself in the middle of one of these tax brackets with room to add more income without pushing yourself into a higher bracket. For example, in 2026, the 22% bracket for married couples filing a joint return goes from about $50,401 to about $105,700. If you file a joint return and your taxable income is $100,000, that means that you could add another $100,000 of income without going into the next bracket. Making a Roth IRA conversion like that could make sense. If you plan to convert a large IRA, this approach is often more tax efficient than converting the full amount in 1 year. You may make smaller Roth conversions over a number of years, filling up your bracket each time. This can help reduce the average tax rate you'll pay on your converted money and also spreads the tax bill out over a longer period. So by doing multiple years of smaller Roth conversions, you'll more than likely, with some planning, be doing that at a lower tax rate than doing it in big chunks. Some tactics you could use in managing income around tax brackets might include withdrawing tax-free money from life insurance policies to keep income low, selling highly appreciated stock for low or no capital gains tax, taking distributions from IRAs or 401ks to take advantage of a lower tax rate. And as we've seen, you can also consider partial Roth conversions to fill up lower tax brackets. There are also two other pre-retirement strategies to consider, but they don't apply to all people. First has to do with how you use a health savings account. This would only apply to people who are covered by a high deductible health plan. The second has to do with small business owners. Those who want to be extra tax savvy and savings for retirement can fund a company pension plan, which for certain high earning business owners can increase their ability to claim qualified business income deductions. Both of these features of the tax code could be used to manage your tax exposure and provide significant tax-favored benefits throughout retirement. If either or both of these apply to you, go ahead and make a note and on those questions, and you can reach out to me. We've seen throughout our presentation the critical importance of managing our tax-deferred accounts, because at some point you'll be forced to take out required minimum distribution, or RMDs, and that can be troublesome to your tax bill. So many people make charitable donations supporting their favorite nonprofit with annual gifts. So let's look at how your RMDs and charitable giving may work for you with some planning. Meet Albert and Shirley, who are in the 24% tax bracket. Now, the standard deduction for a married couple filing a joint return in 26 is $32,200. But Albert and Shirley are over 65, so they each get an additional standard deduction, bringing their total standard deduction to roughly $32,200. For purposes of this scenario, because they're in the 24% marginal bracket, meaning their taxable income is $207,000, we assume they don't qualify for the enhanced senior deduction of $6,000 a person that phases out at $150,000 of income, fully phasing out at $250,000 of income. However, if they take the standard deduction, they would qualify for the maximum $2,000 of MFJ, additional charitable deduction, available in 2026 per the One Big Beautiful Bill. So if Albert and Shirley have $15,000 of existing itemized deductions, say from state and local taxes, deductible medical expenses, mortgage interest, and what happens tax-wise if they donate $5,000 to charity? They get no federal income tax benefit from making the charitable contribution because it doesn't exceed their $32,200 standard deduction. That's not to say they shouldn't do it, but they should understand it's not helping them save on taxes. Now, if you're over 70 and a half and have an IRA or inherited IRA, there's another way to give to charity simply other than by simply writing a check. It's called the Qualified Charitable Distribution, or QCD for short. So let me explain how it works so you can see why a QCD can be so powerful. First, some rules. If you are 70 and a half or older, you can make a qualified charitable contribution of up to $111,000 for 2026, adjusted for federal inflation each year from your IRA. If you're married and both of you are 70 and a half or older, and both of you have an IRA, you can each make a $111,000 qualified charitable contribution from your IRA. Second, any qualified charitable distribution you make counts towards satisfying your required minimum distribution for the year. However, when you make the distribution from your IRA, it must go directly from your IRA to a qualified charity, or you can receive a check from your IRA custodian made payable to the charity. Third, this is the odd part, even though you gave to charity, you get no income tax deduction. So why would I suggest a strategy where you get no tax deduction for giving to charity? Because when you make a QCD, the distribution from your IRA is never counted as income when you compute your taxes. Let's see how that helps Albert and Shirley. First, let's suppose Albert and Shirley do what many retirees do. Albert takes his required minimum distribution for $5,000 at the beginning of the year and deposits it into the bank. He's done that, his RMD for this year, and he's done. Now, being charitable people, they donate $5,000 to charity. The end result is the charity gets $5,000. Everybody understands that, right? So let's look more closely. By virtue of giving to the charity this way, Albert and Shirley's $5,000 charitable contribution will cost them a total of $5,720. Why? Because the $5,000 RMD that went into Albert's checking account at the beginning of the year still has tax cost. However, under the new $2,000 married filing joint couple charitable deduction, only $3,000 of that distribution ends up being taxable. Remember, the couple was in the 24% tax bracket. 24% times 3,000 equals $720. The $720 of additional tax that Albert and Shirley must pay when they file their taxes mean the total cost of their charitable gift is $5,720. Remember, the gift didn't impact their standard deduction. The RMD behind the gift just added to their income. Ouch. Now, let's see what happens if Albert and Shirley use the QCD to give the $5,000. Instead of requesting a $5,000 distribution from his IRA to go to his bank, Albert would simply have his IRA custodian transfer $5,000 RMD directly from his IRA to the charity. That satisfies Albert's yearly RMD because he's over 73. Now the charity is in the same position as before. They receive a $5,000 donation. Good day for the charity. Albert and Shirley, however, are in a better position. They still get $5,000 to charity, even though they receive no deduction. Their IRA distribution is excluded from their tax return. Therefore, they owe no more income tax on the $5,000 distribution. Their total cost to give the $5,000 to charity is $5,000, a $720 savings for our previous example, simply by knowing how to use the tax rules to their advantage, and they did it all without ever getting a deduction. The other thing is, from this example, you can see that by shifting that income from the IRA to a charity, it might help them manage Irma cliffs down the road as well. Now we all know that charity starts at home, so it's a natural question to ask: how does retirement tax planning figure in? It's a very good question because the government still wants its share of those tax-deferred assets when you pass away. And like we've seen, how you set things up really matters, which leads us to our final key, number 4. Organize your assets for your family's benefit. Estate planning still matters. Okay, enough about death. Let's talk about long-term care. This is not a long-term care presentation. It's about retirement and taxes. But believe it or not, there are a number of tax breaks associated with long-term care insurance. For example, long-term care premiums may be deductible medical expenses at the federal level and possibly eligible for deductions or credits at the state level. On the other side, if you are receiving long-term care benefits, in many cases, those benefits are tax-free. For instance, benefits received for reimbursement style policies are tax-free. In addition, cash benefit style policies are tax-free if they don't exceed the higher of your actual long-term care costs or IRS daily limit, currently $410 a day. Choosing how you pay for long-term care costs can have a big impact on your estate and your heirs. In recent years, non-traditional long-term care policies that blend together some long-term care insurance and life insurance have become popular. Often the first inclination of the insured here is to tap the policy to pay for long-term care, but that's often a tax mistake. Let's take a look at Florence, a widowed woman who qualifies for long-term care benefits and lives at home with in-home care, and her yearly care costs are $60,000. Florence's Social Security benefit is $20,000 annually, which covers her basic expenses but not long-term care. She has a $400,000 balance in her IRA, a life insurance policy with a long-term care benefit rider that will pay $500,000 to Florence's children upon her death. Alternately, Florence could use up the $10,000 per month for long-term care costs. Any amounts used for long-term care will reduce the life insurance death benefit. Please note, this is just an example, and it's not meant to represent any specific policy, but many long-term life insurance hybrid policies work this way. First, suppose Florence is infirmed for 5 years and uses her policy to pay for long-term care expenses. That's why she bought it, right? Here, Florence pays little or no income tax during this period because she has such a large unreimbursed medical expense deduction. The $500,000 policy pays out $300,000 $60,000 per year for 5 years. That means her kids will inherit tax-free insurance at $200,000, the remainder of the $500,000 policy value. In addition, her children will receive a $400,000 balance in her IRA, which will be taxable to them. Now, let's suppose Florence lives for the same 5 years, but uses her IRA money to pay for long-term care expenses instead. Florence still pays minimal income tax because of her high medical expense deductions. And now the kids will inherit the $500,000 of life insurance completely tax-free, as well as roughly a $100,000 remaining IRA balance that will be taxable. Comparing these scenarios, the ultimate net benefit is unknown because it depends on Florence's children's tax rates. But it's hard to imagine a scenario where paying for her care with $300,000 of taxable money with minimal cost to Florence is not a better option than paying for her care with $300,000 of tax-free money. In the second scenario, we're preserving the tax-free money for the heirs and paying for the long-term care with Florence's taxable IRA money. Okay, we're toward the end and you're probably thinking, goodness, how in the world will we ever manage this? That's a good question, and let's tie it all together. We started with a clear statement about the problem. Retirees often pay more taxes than expected because of a confusing system that treats various income types differently and contains hidden taxes and penalties. So let's do a quick review on what we've learned in the context of the 4 stages of retirement. Under the pre-retirement heading, we saw the importance of understanding the after-tax value of your retirement savings before you retire. And we also saw that in those pre-retirement years, it's critical to consider your tax-deferred savings and start taking advantage of funding Roth accounts to fill up your brackets, something you do through your early retirement years in low tax years. We also looked at how Social Security and taxes, plus the importance of couples, have benefit strategies that consider the surviving spouse. And we saw Medicare has its own tax-like structure that can push you off the IRMAA cliff. And we saw the importance of signing up for Medicare on time, right in the middle of those early go-go years. That's because starting in the middle of your retirement years, you'll be confronted with required distributions, and we've seen the importance of planning your income needs before then and the tax issues involved. And then we saw the importance of setting up your assets and manage them during the later years of retirement so that you can preserve the most for your heirs and leave them with the most tax flexibility. All those items together lead us to this obvious solution for our original problem. Because tax exposure will change throughout retirement, you need a strategy that anticipates how and when you tap assets to cover personal expenses, understand the range of taxes you'll face at various stages, and manage your actions so you can pay the lowest tax possible. By attending this presentation, you're indicating that you're preparing to leave the accumulation phase, saving for retirement, and moving to the distribution phase when you start spending. We've seen the distribution phase is more complicated than working and collecting a paycheck. Managing your tax rate through the 4 stages is part of the challenge of retirement planning, and we've seen the cost of mistakes. Naturally, we want to be efficient with our savings, and there are strategies to reduce your tax burden, but as with many things in life, this takes education, planning, and advice. It's a lot to think about, and our tax code is complex and the rules keep changing, but what doesn't change is that you need a plan. If you have any questions, feel free to email me at the email address on the slide. Also, because you've spent some time with me going over this, you're all welcome to set up a Zoom phone or in-person meeting at your convenience. If you'd like to have a retirement planning strategy meeting, it's complimentary. If you bring in your tax return, there are some reports that we can run for you that you can take home that summarize where you're at this particular point. If you do come in for a meeting, we identify where your family are at for preparing for retirement, review your timeline, and identify key retirement planning and tax issues that you might need to anticipate. Coming out of the meeting, you'll be more informed about your retirement planning needs and what you want to consider doing next. We work with families that are going into retirement or already retirement quite a bit. That's where you send your questions, jbudd@buddwealth.com. Call us on our 800 number and you can follow up. There will be a link in our follow-up email. It'll have a link to set up a meeting, learn about our process. There's also resources that you'll see there, like the key financial data for 2026 and the summary of all the tax planning challenges in the 4 phases of retirement. There'll be a link to these resources in the follow-up email as well. You can also request our introductory kit if you wish, information about our process and how we help steward to families. Appreciate your time today. I hope that you found this information helpful and a good use of your time. Thanks. Have a great rest of the day. I appreciate you attending.